Very good afternoon and welcome to the Mutual Fund Corner. I'm Nigel D'Souza and with me is Sumaira Abidi. Well, every Tuesday and Thursday, we'll answer all your mutual fund queries and equip you to create wealth by benefiting from the magic of compounding. We'll bring you and in fact keep you in touch with the top financial advisors who will analyze your portfolio and provide recommendations as well. All that and more in just a bit. For the time being, the markets are looking quite good after many days of losses. 7 straight sessions on, in terms of a losing streak. The Nifty is doing a good performance today. The European markets, well, they are relative underperformers because, the Nifty has been underperforming actually, but this time it's a bit of a switch in terms of roles. The Nifty at the high point of the day, the Nifty Bank as well doing quite well, and very good to see with the Nifty holding above the 100 DMA mark. That's around 10,691. In an uptrending market, you have the nearest possible strike. That's the 10,700 put. Very active today. A huge amount of open interest is what we've seen at around that 10,700 put level. That should come up for you on the screen. Added nearly around 10 lakh shares, so keep an eye out on that front, giving you a sense that the bulls believe now they can defend the 10,600 odd mark. We'll talk about that and more. First up, running you through all the top stories. The market rebounds after 7 days of a fall, led by corporate banks like ICICI and HDFC Bank. Reliance too pulls the markets higher. IT biggies like Infosys and TCS take a knock. The mid-cap index near the high point of the day. And Imami promoters, they sell 10% stake for around 1,600 crore rupees. The stock surges on management's comments that the proceeds will be used to pay debt. Macquarie says that the move will remove the overhang of pledged shares. And Reliance Power too looks to follow the Imami example. cnbc TV18 learns that the company has appointed JP Morgan as the banker to sell 18 to around 19% stake out of their direct holding of 30%. That's an exclusive. And metal stocks are higher, led by a big move we are seeing in Vedanta. JSPL as well tells cnbc TV18 that irrespective of the Oman listing, the company will reduce their debt by 10% in this fiscal. And FMCG stocks, they are making the news. The management of Bata tells cnbc TV18 that margins are sustainable at 20% plus. They expect double-digit growth going forward, while TTK Prestige says that the online sales have dropped by 50% due to the changed e-commerce rules. Okay, all right, Sumaira, that's it from me. Off to you.
Nigel, thanks very much for that. I have Vishal, Dhawan of Plan Ahead Wealth Advisors who joined in this afternoon to answer all the queries that are coming in. So Vishal, hi, good afternoon to you. Thanks very much for joining in.
Pleasure
and,
to be here.
we have an interesting caller actually who's already connected to us. So let's just start. Ankit Agarwal is on the line with us from Gujarat. Hi, Ankit. Good afternoon. How can we help you?
Good afternoon, ma'am. Ma'am, I'm 27 years of age and I'm planning for my retirement. I have been investing around 20,000 rupees per month for the last 3 years. I have been investing in HDFC Midcap, DXP Small Cap, SBI Magnum Midcap and Aditya Birla Sun Life MNC Fund. I have been putting 5,000 per month in each of these 4 funds. And I have recently started an SIP in Axis Midcap worth 5,000 and ICICI Prudential Banking and Financial Services Fund 5,000. So I wanted to know if the funds are according to my goal. And also I needed your opinion on Kotak Low Duration Fund.
Okay, Ankit, it looks good. Good that you've started off early. You have a fixed goal in mind. But any idea of how much you're looking to accumulate?
Ma'am, I have no idea as such, but I believe I need to retire at the age of 50. So I have only 23 years in my hand. Okay.
Well, I want to retire at 50 also, Ankit. So that's a good thought. Okay, Vishal, how does the portfolio look? It's a little aggressive to my eyes. How does it look to you? But given that he has, 20 years plus on his hands, does he require much change?
So I think the clear benefit is that he's giving himself a lot of time.
Yeah.
But what does tend to happen is it's a very mid-cap focused fund portfolio. And the challenge with the portfolio of that kind always tends to be that whenever mid-caps do badly, like we've seen in 2018, you do tend to have a lot of weakness across your portfolio at the same time. So we would say that, while the choices of funds are good, I think it's much better off to really run a very diversified portfolio, even if you have time on your side. Even if you look at the MNC fund in the portfolio, while it might feel very different, ultimately it is a very mid-cap loaded fund. So ideally, recommendation would be that pare down the number of schemes in your portfolio. Look at holding the Birla MNC. Look at holding the Axis mid-cap. Look at holding the DSP small cap. I think it's giving you a flavor of different parts of the market. And look at adding in one index fund, just so that you get the benefit of market movements which will come because active managers will have periods where they will underperform. Yeah. And I think then just look at this portfolio once a year. Keep enhancing your SIPs as you go along, because ultimately what tends to happen is your lifestyle changes as you move from 27 to 50. And one of the mistakes that we see a lot of people make is that their 25,000 rupees a month SIP remains at that level for many, many years. And I think it's a great idea to just enhance it as you go forward.
Okay, Ankit, any more questions? I think you wanted to know about the Kotak Low Duration Fund as well, right?
Exactly.
Okay.
Yeah, so let me talk about the Kotak Low Duration. So again, it's got a good track record, but what we have to remember is it's got credit quality which is a little suspect. It's got a lot of exposure to AA and below rated papers. And it's also a little expensive. So ideally, if you're looking at using this as a kind of protection tool to a very dominantly equity portfolio, or maybe as an emergency fund, then we think you need to get better credit quality and lower expenses coming in. So maybe the SBI low duration might be a better option than the Kotak low duration for this kind of need.
Okay, Ankit, I hope that answers all your questions.
Yes, ma'am. Yes, ma'am. Thank you.
Okay, thanks very much. All the best. Up next, Rahul Verma is on the line with us from New Delhi. Hi, Rahul. Good afternoon. I believe you want to sound Vishal out about your mother's portfolio?
Yes, ma'am.
Go ahead.
So I have 3 short questions. She is having a pension of 3,000 monthly, apart from the 15 lakhs which she has invested in senior citizen savings scheme. So my first question is that should she invest that amount in her active PPF account because it has 8% return and tax exempted, or should she invest in a large cap fund? She wants in a time horizon of 5 years. Second question is that she is earning an interest from the senior citizen savings scheme, which is 30K quarterly. So where she wanted in a short-term period. So should she invest in a bank FDs, or in which mutual fund she can invest? She needed it for our younger brother marriage after. Okay. Third question is, how important is to invest in a direct funds compared to a regular scheme from long-term perspective?
Okay, Rahul, I have a couple of questions for you. The pension that you're talking about is X of living expenses, right? That's purely the investable surplus that you've spoken to us about.
Yes, yeah, it's purely accessible.
Okay, and your mother also has other investments, or is this the entire extent of what you've told us?
No, she has this only investments, whatever, 15 lakhs which she had from the senior citizen.
As well as insurance, everything is taken care of, right?
Yes, yes.
Okay, Vishal, having heard Rahul's query, he has 2 needs. One is for 5 years where they have an investable surplus to put it, and the choice is between the PPF or a large cap fund. Second is they need something for the shorter duration for an upcoming wedding. Where should that money go?
Okay, so I think let's take the first one first. So as far as the money is concerned for taking care of the 5-year goal, considering she has no real other investments, she's likely to be in a fairly low tax bracket. And therefore, the benefit of a PPF account with its exempt status may not be as significant for her at 8% as it is for someone who's in a much higher tax bracket. So very clearly, I think, considering her 5-year investment horizon and probably the need to have some part of a portfolio beat inflation, it may be a good idea for her to consider the use of an aggressive hybrid equity fund. I think with a 5-year investment horizon, going to pure equity may not be good enough. But with an aggressive hybrid equity fund, which has about 65–70% in equities and the rest in bonds, I think there's an opportunity there for her to be able to put some money away and take advantage of that. So between PPF and the large cap fund, I'd say neither. Let's go with an aggressive hybrid equity fund. The ICICI Equity and Debt Fund, for example, is a good option in that space. For the second need, which is really, short-term marriage for a son, I think one of the challenges always is you probably don't know when that marriage is actually going to happen. And therefore, you need the flexibility to be able to pull out the money whenever you want, with very little penalties and certainly no losses there. So we think that in either a bank fixed deposit or an ultra short-term fund could both be options. We just marginally prefer the ultra short fund for two reasons. Number one is the fact that it's very flexible to be able to take out whenever you want the money. And number two is that if she's getting her inflows coming in quarterly, she can run a quarterly SIP to automatically sweep that into the ultra short-term fund. So in that way, it's an automatic process. It doesn't require a lot of effort from her side or from her son's sides. And whenever she needs the money back, she gets it back in 24 working hours. So I'd say that an ultra short-term fund, good quality papers, low expenses could be a good option for her to look at. So the Kotak Savings Fund, for example, could be a good choice for her to look at in that category.
Okay, Rahul, does that answer all your queries?
Yeah, ma'am. I have one more question.
Sure.
How important is to invest in a direct funds compared to a regular scheme?
Oh, I'd say very. But I'm going to let Vishal do the explaining.
So very clearly, the difference in expenses are significant. And as you invest for longer periods, the compounding impact of that expense difference is very large. I think the important part is to really be able to figure out, however, that are you in a position to be able to manage your own money? And it's not just about, going online and looking which is the right fund to buy. It's not about, reading the newspaper, hearing a television channel. It's about, can you manage your behavior when equity markets actually go through tough phases? Or are you likely to panic and just kind of pull your money off? If that's a challenge, then we think that, you still may need some hand-holding by an advisor. Maybe you can still use a direct plan and, pay an advisor a fee for managing your money. But typically what would happen is direct plans are a good option for investors to look at if they're confident that they can manage their own emotions along with managing their fund choices.
All right, Rahul, does that work?
Yeah, thanks so much.
All right, thanks very much for calling in. Let's take a very quick break. We have lots more queries that we need to answer. Vishal is going to stay on with us, and we'll be right back after this quick break. Back, you're watching the Mutual Fund Corner. With me, I have Vishal Dhawan of Plan Ahead Wealth Advisors, who's been answering all our queries. And up next, we have a query that has come in from Rakesh Patel. He's written to us from Netherlands. So he wants advice on creating a corpus of 3 crore rupees over the next 15 years for his child's education. Now, Vishal, a little sketchy on details in terms of, we don't know, what else he has, but nevertheless, for this one specific goal, which is 3 crores over the next 15 years, how much does he need to invest? Where does he need to put it? And how does he manage this portfolio?
So I think the
other thing being, I don't know if he's an NRI or what is his status, and therefore what might be the tax implications.
Sure. So I think there are 2 or 3 things that we need to keep in mind. One is obviously he's got, a clearly defined objective, which is good. What we know is that, there are 2 ways that you can run a strategy per se when you're trying to build wealth. One is you go all the way till the end, being aggressive, and say that, I'm going to run, because I have a 15-year investment horizon, put all this money into the equity markets. And essentially, if I'm able to save about close to 60,000 rupees a month, then I should be able to get to that objective of 3 crores. What we have to remember is, 3 crores sounds like a big number, but if you discount that to today's value, we're talking about 54, 55 lakhs. So it's not as large a number as it's made out to sound. So you kind of do 60,000 a month for the next 15 years, and hopefully equity markets, like they've delivered over long periods of time, will do at least 12 to 13% a year, and you'll get to your objective. The other way, which is probably much more suitable, is to actually break your investment into phases and say that for the first maybe 10 to 12 years, I'll be a lot more aggressive with the money because I have time on my side. And then as I get to the last phase where I might need to draw down on the money, I then be much more conservative. Now, if that happens, you'll effectively end up running an equity strategy for the first 10 to 12 years and then a debt strategy in the next 3 to 5 years. And suddenly, from having to save 60,000 rupees a month, you'll need to save about close to 78 to 80,000 rupees a month. So I think trying to figure that out is very important, because most people don't clearly define this upfront. And then when they reach the point where they suddenly need the money, they find equity markets aren't doing well, and they're kind of like very disappointed because they spent 15 years and didn't kind of take advantage. To the question around the NRI bit, really the tax laws are fairly similar for non-residents and residents on equities, for example. The only difference being that there is a tax deduction at source, which happens for NRIs as compared to resident individuals. What one needs to keep in mind, though, is that in every geography, there might be that country's tax laws also that you need to keep in mind. What tends to happen is for a lot of people, they keep the tax laws in mind of their home country or the country in which they're investing, but they miss the fact that the Netherlands, for example, could have its own tax laws which say that if you earn income, say globally, this is how you need to tax it, or this is how you need to report it. Sometimes it's not just about taxation, but it's also about just reporting it right. So I think some of these nuances need to be kept in mind. So getting good tax advice is also critical as a part of this process.
Okay, Rakesh, so I hope you keep all of those points in mind, and I hope you actually, put this advice to work. Up next, Prachi Jain has written to us from Mumbai. Now, Vishal, she's only 29 years old, and she has marked out her goals very clearly. She needs 20 lakhs in the next 16 years. Then 50 lakhs in the next 20 years, 1 crore in the next 27 years, and 5 crores at the end of 30 years. So the first advice she needs is, how does she structure her portfolio? How much does she need to invest to achieve all of these goals? And, many of them are actually close to each other, right? The first two are just 4 years apart. The next two are just 3 years apart. And finally, she wants to know that, between the SBI Small Cap and the L&T Emerging Business Fund, which would be better over longer time frames?
Okay. So I think clearly, while there are multiple goals, all of them are at least 15 years away. So that kind of gives them a certain time to actually grow. And I think that allows this entire strategy to be very equity focused. From an overall perspective. So, if you're going to have to target to get 20 lakhs, first of all, in 16 years, and let's assume you target a 12% rate of return, which I think is reasonable considering, all that will happen over the next 15 to 20 years. We think you need about 3,900 to 4,000 rupees a month to get to that target. To get to the additional target of, 50 lakhs in 20 years, you need about 5,700 a month. If you're trying to get to 1 crore in 27 years, you need about close to 5,000 rupees a month. And then at 5 crores in 30 years, you need about 17,000 rupees a month. So all of this assumes an equity-heavy strategy, 12% a year kind of numbers. And like we were discussing earlier as well, I think as you get closer to those objectives, you might need to taper down the risk on the portfolio to make it happen. I think the important part about setting goals for yourself is also to revisit these goals on an ongoing basis, because life changes as much as we want it to all work like it works in Excel. Unfortunately, life has other plans for all of us. So I think it's important to measure this on an ongoing basis and also take remedial action wherever needed. Sometimes it may require you to enhance your saving so that you can still get to your goal. Sometimes your goal number itself becomes larger. So having said that, I think the important part is, to run a strategy which is kind of going to take you through this long period of investing. So we'd say that try to allocate money across 4 broad buckets when you're trying to save towards this. Put about 30% of your money in index funds. They will give you what the market returns. Do about 30% in multi-cap funds. These will have about 70-75% of the money in large companies most of the time. The balance 20 to 30% will be in mid-sized companies. Do another 30% in mid-cap and small-cap kind of strategies, and do 10% internationally to be able to diversify away your India risk over periods of time. And specifically to the question around, SBI versus L&T, the way that we look at it is L&T Emerging Business has a good track record in terms of how it's managed risk along the way. So they do some good things around risk management.
So that's already a winner then.
And it kind of works well. We clearly think in that space, which is very small cap driven, risk management is a very, very big part of that strategy.
Yeah, I tend to agree with you. I mean, I couldn't agree with you more that managing risk is actually much better than looking at past returns because they may not be replicated in any case. All right, Prachi, I hope that works for you. All the very best. You're on the right track, and I hope you implement it as well. Vishal, thanks very much for dropping by and for answering all the queries that have been coming in. We'll wrap up on MF Corner for now, but do stay tuned. All the market action comes up next with Closing Bell.